cloud, as you pointed out, was a key driver for IT companies' strong growth over the last few quarters. IT companies roughly earn about half of their revenues from digital solutions, most of which is directly linked to cloud offerings from hyperscalers like AWS, Microsoft Azure, Google Cloud. While the growth of these companies is still very, very strong, there are some signs of slowdown which are emerging. Ambit says cloud moderation indicators are emerging, though not fully conclusive. Let's break this up into three brackets. First, hyperscalers like AWS, Cloud, Google Cloud, that is, Microsoft Azure. Second, the SaaS companies. And third, the equipment providers to cloud companies. So starting with the hyperscalers. Now, hyperscalers' growth has slowed down in the current quarter. Take a look at the numbers of Amazon Web Services and Google Cloud. In the quarter ending June 2022, that's the current quarter, revenue growth for Amazon Web Services was up 33% on year-on-year basis, but it's lower than the 37% growth that it had in the March quarter. Similarly, for Google Cloud, revenue growth slowed down from 44% to nearly 35% on a quarter-on-quarter basis. Secondly, even SaaS companies are warning of some slowdown, and there have been some guidance cuts, worries about elongated sales cycles. So one of the companies, Salesforce, trimmed its full-year revenue guidance by 200 basis points to 20% constant currency revenue growth versus 22% earlier. ServiceNow, another company, trimmed its full-year revenue growth guidance by 50 basis points. And other companies like Zendesk, Duck Creek, Pega, they're all warning of elongated sales cycles. And finally, the third leg of this, these are the equipment suppliers to cloud companies like Seagate. And Seagate just last week downgraded its Q1 FY23 revenue forecast. The company said incremental weakness on enterprise side was seen due to a cautious buying behavior among global enterprises, OEM, and certain US cloud customers. So the question that we're now asking is, why is the current macro slowdown that we're currently in impacting the IT companies, the software companies, the tech spending? Well, let's just take a step back. Now, post-COVID, clients opened the floodgates for discretionary spending to accelerate for cloud migration, digital transformation initiatives. But after 12 to 18 months of accelerated spending on technologies, the current uncertain macro has made enterprises take the foot off the pedal. Enterprises have now renewed their focus on cost savings and programs which generate a quick ROI, return on investment. Even as the digital transformation over the longer term, the initiatives still continue with full swing. But now what's happening is that tech budgets are receiving higher scrutiny. They require a greater level of approvals from the CFO office, C-suite, or even the board. And this is resulting in slower decision-making and longer deal cycles than we've seen in the past for software companies. Even in segments which were perceived to be relatively resilient, like data analytics, low-code, and automation. And as I said that, while there are certain red flags which are emerging, broadly, the enterprise market still remains very, very resilient, and digital transformation journey is continuing and even strengthening in a few cases. So the long term is still perhaps very much intact. But the question is, if there's really a broad-based slowdown in the enterprise level decision making and it gets worse, can the Indian IT companies remain immune, or will there be a trickle-down effect? Let's tell you the read-through from Indian IT. Kotak says that they believe tech spending, that is a function of the natural growth in business, can be impacted in a weak demand environment. For example, cloud consumption growth can decelerate, not necessarily because clients are slowing down cloud migration or their digital initiatives, but due to a lower storage or compute requirements in the case of an economic downturn. Vendors too, the vendor commentary indicates that digital transformation trend will only continue. So they're saying that FY23, we're unlikely to see a slowdown, but there could be a deceleration in growth FY24, which is something the street is already expecting.